investors can use equity futures as a new instrument in the market. This will provide them with new strategies that you can use in investing. One of these strategies is hedging against market volatility, using the futures to make the volatility of returns much less than in usual equity investments. The other thing is the leverage component, which gives the investors the opportunity to have higher exposure, which means higher risk in their investment in the equity. Margins work where an investor takes a position in the market. He posts a fraction of this position, which is called an initial margin. And then after that, when the stock starts trading, there is something called the maintenance margin that the investor has to maintain. And this will be facilitated by the exchange itself. And they will let the investor know what they need to put in as an extra cash to maintain the maintenance margin. Shorting basically is making use of the downside in equity markets. So the investor has the ability to choose a stock that they think that it will go down in price. So they can make use of this downside by shorting the stock and then buying it later at a lower price. The main risk in trading futures is basically the component of leverage. So my advice is that investors, they need to understand the product very well, and they need to understand the payoff of the futures instrument very well, and calculate the payoff at each level and control the risk for the investment. The main advantages of the futures market is the ability to short, which is not available in the regular market. Having an opportunity to make returns from downside in futures market is a new feature that regular equity markets do not have. The other advantage I see is the ability to hedge the exposure. So for example, a lot of investors, they are invested for the long term, but they need to hedge against short-term volatility in the market. So what they do is they sell short an index or one of the instruments to just make the volatility of the returns much less. The disadvantage is the use of leverage. This obviously, as much as it amplifies the returns, it puts a lot of risk on the downside. Investors need to worry about this and need to understand exactly what are the risks and understand the instrument very well. My advice for the investors is trade this instrument, but understand it very well. You have to study it and you have to know the margin requirements for this future market, and you have to understand the payoff very well. This will help you contain the risk and help you make the returns much better.